Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, October 16th, 2020. What we're going to do is a brief update on the equity markets. I already posted a video this morning, so I'll update what's going on there and spend the bulk of the video reviewing. We're not going to go through a ton of charts, but we're going to look at the major developed economies via ETFs. There are some interesting developments I want to point out that they especially speak to the longer term or intermediate term outlook of the market. So we'll get to those after the brief update on the U.S. markets here. Okay, so this morning as I was doing the video, outlined the first resistance levels likely to come into play, objective levels to book profits if you went long yesterday, and or reverse to a short. That was 2340, and then you had the downtrend line above on it, and QQQ. We effectively hit 2340 again. Effectively 300-point index. So let's just look what the high was. I think it was a little bit below that high, 293.27. So you're off, 13 cents on a 300-point security. That's a fraction of a percent. And you always want to step in early. If a well-watched resistance level, the sellers will often step in early. So would have made sense to again, if you're an active trader and that was your trading plan, sell your longs there and or reverse into shorts. And so far, a decent pullback, nothing huge. Let's see, from the highs, QQQ has fallen about over 1%, 1.1. So we'll still watch these the uptrend line, the triangles. We're still pinched in between there. Here's support, the top of the box right there. That's the gap from Monday, and that should act as support with the trend line just below. Again, break of that bearish. Should we step in and bounce there? Break to the upside of the triangle, bullish. All right, that's QQQ. Let's look at the NASDAQ 100 futures, and then we'll look at IWM. NDX, NASDAQ 100 futures, I listed this morning 120.30. I called it 120.30 is the resistance level. We're likely to get a reaction. High was 120.22. Again, 8 points on a 12,000 point index. That's basically a hit right there, perfect reversal. And I don't know if I had it in this morning, but if not, I've added this uptrend line right here, which we're at right now. So this is a logical place for the buyers to step in. But if they don't and it breaks, then that's going to open a door to a move down. I'll have to, this support level, I'm going to move here. I'll do this right now. That line should be moved up at this point to that reaction low. So there's your next support below the trend line, about 11,742 or so, we'll call it. And then these lines are good here, about down to about 11,600 to 11,550 or so. Something to note too before I get off this chart. Look at the PPO rolling over after we're pretty much, remember, it's the signal line, the last of the two to cross, the 9 EMA, the white line, and that is right at the zero line on this 60-minute chart at NQ. So if we get that bearish cross and this PPO turns down, then that's a rejection at the bearish at the zero line. And again, that's one useful tool is a trend indicator. When that white line's above, the trend is bullish. You want to be long. When it's below, the trend is bearish, and you want to be short. So very open to the possibility we break down here. And again, I just gave you first and second target. That's more of a target zone there. But the top of that level probably bring in the buyers if we get there. And then likewise, if you're bullish, you want to see NQ bounce off this trend line and then go on to break above 12. Be safe. 1231, 1232. Or 12,031 or 12,031, 12,032. IWM, no change. Remember IWM, excuse me, the small cap ETF ran into resistance first before QQQ did, which pretty much made it stall out here at that downtrend line. So you still have the similar pattern. It's not a symmetrical triangle pattern, but it's a triangle. Not so many reactions. So this trend line's it's a little less valid than the one on QQQ, but worth watching. And then reaction highs just above there. You can actually put horizontal resistance just above about 164 because you have several reactions there at that level so far. RTY small cap futures, somewhere in here, I've got it. There it is. Same story, no change. There's the downtrend line right here on the 60-minute chart of RTY. Tag, multiple tags. it's resistance, bumping up against resistance, and also holding just above support right here. So near term, again, obviously, will help to see QQQ break down, but break down below that 16, that's about 1634 bearish, break upside bullish. But, again, you have a couple reaction highs just above. So, you might want to see a little more upside, some solid green candles coming in there. And if we do get that break, that pop today, let's say, unfortunately, it might not go very far because you're going to have negative divergence here on the 60-minute time frame. It looks something like this. That's if it pops and reverses. Pop and reverse, maybe it runs into that previous high or just above it. And if it happens anytime soon, negative divergence. So you can probably tell from my voice, I'm leaning towards the the more downside that these levels will probably go, and we'll get a breakdown here. Of course, as always, stay flexible. Go by what the charts tell you. Cut your losers, let your winners run. All right, let's talk about the global stock market. That's something I haven't done in a while. I used to do it a lot more often. You kind of been wrapped up in the U.S. charts lately. All right, so we're going to flip over back to this charting platform. We're going to go to a daily time frame. That's all we're going to look at. All these charts we're about to go through are daily charts, and I have a watch list of global ETFs with the S&P 500 up top. Global is U.S. plus all other countries out there. Whereas typically, if you buy a global stock fund will include U.S. stocks. If you're just kind of FYI stuff. If you're looking at your 401k and it says global fund, global equity fund, whereas an international stock fund is typically everything but the U.S. That's usually what the designations are on mutual funds. So we're going to look at the stock market around the world. Although the U.S. is still and has been the world's largest economy, and pretty much a center of the markets. In other words, if the U.S. has a big correction, 30-40% or bear market, almost everything goes down with it. But that's not necessarily the case if Italy or Greece has its bear market. The U.S. can shrug that off. So again, but the big economies, the bigger the economy is, obviously the more it matters. So you have the G7. You have Canada, Japan, Germany, and even France. Those countries do matter, and we're going to go over those right now. All right, let's move on. What am I looking at here on SPY? This is just a daily chart, a little uptrend line right there. But one of the most significant developments was this divergent high. Remember, we put in this all-time high right here. What had negative divergence on the PPO right there? Your divergence. Almost divergence, but you had an extreme overbought reading on the RSI that was slightly above that other reading there, and we've corrected, and so far we're still below that. So it's still anybody's game. If we take that out, here's the thing: if we can push up a little bit higher, all we have to do is equal or take out that high from before. So let's just say something like this, and if we do it anytime soon, I'm going to extend that divergence line. Anytime soon, it will still be negative divergence. In fact, you'll also have negative divergence on the RSI. The more indicators you have the divergence on, whether it's bullish or bearish, the more likely it is to play out for a trend reversal. So, based on this, it appears to me any upside in the market's pretty limited at this point in time. And that also meshes with, whether we get if we happen to get a pre-election rally or even a post-election rally that pops us there again anytime soon. Takes a while to change. It would take a while to burn through these divergences on the daily time frame. So keep that in mind. Okay, and the point of this video wasn't so much to cover the U.S. market, although again that all goes into analysis of global markets, but more so to point out some developments. So what we're going to do is, going forward, we're going to look again just a handful, half dozen or so ETFs. Starting with this one, and there are two. I'm going to flip to two different boards. Boards are different. I have different annotations on the different boards, and we're going to look at trading ranges. So when you see these orange boxes right here shaded in the middle, that's a trading range, and I also then have some other developments such as trend lines, divergences, things like that. So we're going to start with the S&P 500. Now this has been one of the, if not the best performing global stock market. I attribute most, if not every bit of this, or at least a good part of it, to the Fed's nuclear response. Again, you can't even underestimate how heavy they came in with stimulus, blew away the crazy things they did back in the last financial crisis, 2008. And so it's gone the market higher. It worked. Got to give them credit. But let's just talk pure technicals right now. All right. So what do I see on this chart? Well, right here, again, I just pointed out the negative divergence, just like we had negative divergence leading into that COVID drop. So the COVID drop, you can say it was all 100% COVID if you want. I will say it was priced into the charts. COVID was a catalyst. I think COVID certainly made the correction a lot sharper than it was. You know, the economic shutdown, I will most certainly acknowledge those fundamentals played into all that. But again, and then just like the bounce of being supersized was, you know, again, aided largely by the Fed stimulus and backstopping of the financial markets and everything else there. But this is the somewhat of the trading range. Again, step back. Look, we're going back many years, and you can see the U.S. market, although it's at new highs, and again, I attribute a lot of that to the Fed stimulus. It is a market that for years, since all the way in the beginning, this is the beginning of 2018, pretty much has plateaued. We had a breakout there to new highs, got checked, ran back to the bottom of the trading range, another breakout. We had divergence here. So let's see, you know, can we shrug off those divergences and thrust up to new highs, or will they play out? In other words, is this wave one down with more to come? And of course, if that were and we fell back into the range, once you re-enter the range, you're usually going back down to the bottom, or at the very least the midpoint. So I'm going to move on here. I'm gonna focus on the other countries, and I'm gonna do something first. I'm gonna show you this. I'm gonna find. Let's see. Let's turn off all the annotations, and just here's something interesting to point out. Okay, so I just showed you the U.S. being at all-time, you know, not at all-time highs now, but not far off it. We recently, before the correction, did. Just about every other country right now isn't. Canada's doing okay, you know, it's our closest cousin, right, you know, next door neighbor, I should say. But they pretty much peaked back here. You can put a line there. Well, I already had a line. Okay, that one needs to go away. And here, let me do it another way. Get all those lines off there. There. So back in late 2017, it peaked, it ran up, made a double top there, and it's still below there. So here's one of the major developed countries that topped and has yet to see new highs. I'll just go down the line. These are the ones we're going to cover. Germany. Germany clearly topped back also in late 2017, early 2018, and is not anywhere close to its high. So still, you can call it what you want. You can call it a bear market rally. You can call this a start of a new bull market. But it's hard to argue that we're not even, you know, anywhere near the previous all-time highs. And so, you know, when you whip out or jump out to a weekly or monthly chart, which we're not going to do in this video, I'm going to keep it focused on the dailies. You know, a case could be made it's a bear market rally. Case could also be made that the bull market, you know, bear market's over and it's the beginning of a new bull market. But until that's taken out, you can't really say that with confidence. EWI, Italy, same story. Italy peaked like everything else back around the beginning of 2018 and is way off those highs. I mean, Italy is, according, you know, this ETF, which does a good job of tracking. This is EWI. Still, you know, trading 30% below those highs. And again, I'm going to get to some other technicals on these in a second. I just wanted to make the point that if you back out the U.S., which again has thrown more money in backstopping of the markets than any other country, all these countries, Japan, clearly still well off the highs they put in. That's almost, 3 years ago, guys? 3 years ago these things topped, and they've been in again, you can argue it any way you want. You can say bear market. If we do this, yeah, that's going to clearly, in hindsight, you're going to look at weekly charts, monthly charts, and say, wow, that was a great bear market rally to short. If it does this, you're going to say, wow, that was we'll call this, right now it's going to go down probably as the fastest bear market in history. I mean, if you want to count Black Monday, that was a 23% drop in a day. But, you know, for the magnitude of that drop, that would certainly qualify probably as the, you know, it was a bear market and you blinked if you missed it, you know. All right, EWQ, France. Okay, so you get the message, or the point here. These guys topped. They're well below their all-time highs from nearly 3 years ago. And that's it. The UK, I mean, this it's not a good-looking chart. EWU, look at the UK is down. Actually, the UK peaked all the way back here in 2015. via this ETF. You'd have to look at the FTSE and some other, but it does a good job of tracking the basket of stocks in the UK. 34% down below the 2018 highs. A couple more. I am very sorry for coughing into the mic, guys. For weeks I've been pretty quick on the trigger to pause when the coughs come. I'm still battling those COVID symptoms, and doctor put me on antibiotics yesterday for bronchitis. Hopefully that'll work. But I thought I hit that button. I completely missed it on that last cough. My apologies. The pause button. All right, moving on. EWU. I just did that one. EWA Australia. Australia still, roll it back. Australia, here's a high back here, and what was that? Late 2014, and it's still below that. Been strong. There's been stimulus around the world. All the central banks have pumped the markets, but I said I wouldn't do it. But you go back to these weekly charts, and this could be the making of a new secular bear market in some of these countries. You really need to take out those lows there to say that. But you have cyclical bull markets, cyclical bear markets, and then you have secular, larger bull and bear markets. But either way, say what you want about it. Australia is still very much off the highs, as is every other developed country around the world other than the US. This is FXI. Now I will say there's other Chinese ETFs that track the Chinese markets. Some of those are making marginal new highs recently, but this is one that's been around forever, and I track it in my basket of global stocks. And there it is. There's your 2018 high, well below that right now. Okay, so there's a point being made that other than the U.S. and if you live in the U.S. and your 401ks in the U.S. and S&P 500 fund, great, it's worked for you. It just hasn't worked for the rest of the world. All right, now let's talk charts and we'll wrap it up here. I already covered SPY. Let me turn on the lines. We're just going to look at 2 boards on each one, and I'm going to go through this quick because it's pretty much the same thing with all these. You guys know divergences are a big part of my trading. Bullish divergences like this right here. Nah, I don't know why I had that line. You have an oversold read. I'm going to take that line off. But on a lot of these charts, you'll see bullish divergences or bearish divergences, meaning negative, like this. These are negative divergences. Boom, 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 boom. And you can see what happens after the divergent highs. This one was small, and it came off also during a V-shaped recovery. This one was a little bigger, led to that. And most recently, we put a divergent high here on both the RSI and the PPO. We broke down, kickback rally, $1,000,000 question. Will it prove to be a snapback rally with another leg down? Or is that it? Is it a one and done, one wave down correction? Maybe an ABC correction, which would be a corrective wave if you follow Elliott wave. ABC is a corrective wave within an ongoing trend. So that's a possibility, but we'll know soon. Let's flip over to the other board I wanted to show you, and that is this. Here's those ranges. So again, we're going to look at these orange boxes. We're going back. You can see the scaling or the dates down on the bottom. This one goes back to about 2018. And other than just a few brief periods, there was a breakdown, V recovery, snapback in the range. Remember, these V recoveries come from the fact the central banks absolutely refuse to let a recession or a bear market happen. And hey, if you own a business, if you own money in the stock market, you want that. But the longer they do that, I've used this analogy. I used it back in 2007. I live in Florida. You guys, if you live out in California or anywhere out west where it's dry and you get the wildfires, the forestry department do what they call prescribed burns. They go through, they intentionally burn down the undergrowth, things like that, because if they don't, it grows, it gets dry, and then when the lightning strikes or the campfires occur, you have so much fuel, it burns the whole forest down. Okay, the reason that we've always had recessions and expansions as part of the economic cycle is the recessions are absolutely necessary to clear out the undergrowth or the dead companies. When you The government, as long as they keep supporting and bailing out airlines that should fail, automakers that should fail, banks that should fail, and other corporations right now that many industries that should fail but haven't because the Fed's backstopping the junk bond market, the low-grade investment, and they're also giving free money out, and that allows corporations, zombie corporations, to continue to survive. And what happens eventually, competition heats up. Now, recession is good because if you own a company, let's say local, and you sell widgets, and you've been doing that for 30 years, prosper, but all of a sudden you have a big economic expansion. It goes on a decade or more, and next thing you know, there's 20 other companies in town selling widgets. You manage your company well. You know how to price your product or your service. But there's a lot out there, and I can tell you this happens where I live, that don't know what they're doing. They underbid, and when the economy is booming, they can get by. But that puts pricing pressure. So the recessions clear out that. They clear out the companies that are not productive, not efficient, and it makes for a stronger economy once you emerge and wash out all that dead wood in the economy. And again, that's my longer term view. Okay, this is, and so what's happened here is pretty much this is where a bear market should have. In fact, it's where a bear market started with the rest of the world, other than the U.S. And we've just seen stagnant growth now for many years. And again, here's your range. Let me get back. I'll get off my little soapbox here. There it is. One V-shaped recovery. Again, central banks would not allow that. They came in, they flipped. I remember back then, and I said they would do it on the way down. U.S. started hiking rates, started getting hawkish, and I said, mark my words, they're going to pull a 180 and get dovish, and that's what they did. And they came in here and said, okay, sorry, we were wrong. We're not going to raise rates. In fact, we're going to lower rates. And so everybody, they put the punch bowl back out for everyone to drink out of, the free money punch bowl. And that, but again, what's it done? It's just created this zombie-like market here. And from a technical perspective, again, going back, all right, forget about all that fundamental stuff I just said. There's your range. And like most trading ranges, you can put a midpoint line. It's not always in the middle. There's my midpoint line right around 29. Why? Because that's what's capped a lot of the, it's acted as support and resistance. And there it was support, but you gap down below it, boom, right to the bottom of the range. When you broke above it here, boom, right up to the top of the range. So a very, very well defined level, and that's what capped this advance, and we're just below it right now. So that puts EWC, or Canada, in a precarious technical posture, especially coupled with that recent divergent high and breakdown right there. And now if it can get above that, bullish. So there you want to know, pops above 29 with conviction, boom, probably opens the door to the top of the range. And ultimately, if it can break above the range, then that's bullish. Or if it breaks down below the range again, well, you know what happens when it breaks below the range. So you don't want to wait too long to get out of your longs or get short if that happens. Next one up, EWG, Germany. First, the trend lines. All right, so same old story. Divergent high right here, correction. Divergent low, that was a divergent low, rally. Divergent high, correction. Divergent high, breakdown, kickback rally so far, just like you had, kickback rally over here. And again, $1 million question. This is a potential secondary trend line to watch. Let's flip over to the range. Not as well defined. I have to say that some of these boxes are not as well defined as others. Here you have a series of higher highs so far. You definitely had some resistance here. It was a resistance level. We finally broke out, ramped up to new highs. Germany fell back, back tested for months. That's many months. Finally, when we gave up that level again, one initial sharp leg down, one back test, couldn't break back above, boom, right to the bottom. So this is I think a significant level for EWG, the Germany ETF. Okay, next up, Italy, EWI. Same story here, same wash, rinse, repeat stuff. This was a divergent high. It's not marked. Divergent high, marked, ended with a divergent low, led to that rally. Divergent high led to that correction. Divergent low led to this rally. Divergent high led to that drop. And most recently, another divergent high. Is this, leg one down, more to come, or is that it? We'll see. Boxes, let's see, do I have, nope, I don't have, I didn't put any boxes on EWI because I can't. I'm not going to force it. I don't like forcing trend lines or drawing. This is, as you can see here, kind of a uptrend there, a range, but I don't see any areas that I can box in real clear, so we'll skip over that one. EWJ, Japan, same old story, divergent high correction, divergent high correction. It hasn't broken down yet. This is a little wedge type pattern, but it's rallied into that 50 or 60-ish resistance right there, and with negative divergence. So a sell signal will come on a solid break below there, and these would be your targets. Let's look at the boxes on it. That's it. I'm actually going to add a second box here. I meant to do that before. Box tool, right about there. You can see, a couple reaction points there. Maybe a little higher. There's a gap right there. So that would be first support or target if you're swing trading, and then that's the bottom of the box. EWQ is France. And you have divergent high right there, just like you had one here, just like you had one here, just like you had a divergent low right there, just like you had a divergent low back here. You can just add the divergence lines right there and right there. And so same story. So yeah, obviously, look, the global markets trade, day to day or month to month, week to week, pretty much in sync. But again, there's been a clear pattern of every other country but the U.S. stair-stepping lower now for last several years in most cases. Boxes on EWQ. There's my box. Goes back all the way, let's just say most of this trading here since about 2017. And my midpoint line is a little below the actual midpoint. It's about 28.43. Why? Because you have reactions there, reactions here, big old gap. That's certainly technically significant. I'm kind of slicing through it recently, but again, these are the previous highs that have capped, France, and it's still, about in the midpoint or a little bit lower than the midpoint of the range, and then the bottom of the range here, you had some resistance up here. Big old technically significant gap there, and then you re-entered there. So that's what the boxes look like. EWU, the UK. Again, might want to look at the FTSE and some other indexes, but this is going to do kind of give you an idea of what's going on there. And I told you before, UK peaked way back there, has been moving lower, making lower lows. So this one, from, you can say, all the way back here to 2015 or so in a bear market. We have this recent trading range right here, and I think that's significant. Whichever way this pops could determine the next trend. And then I go longer term. Here's my boxes right here. We have this bigger box again for many years, the past several years. This is really contained the bottom, and this is very technically significant. That's a lot of major reaction points right there. And during the COVID plunge, the UK, EWU at least, dropped below there, made a perfect back test, rejected, and remains below. So this is in a bearish technical posture. It has not regained or gotten back into that, and obviously a pretty important economy. Then more near term, if it happens to, you have a few reaction highs right here. So there's a smaller and some reaction lows right there, reaction highs. So that would be a potential target if we get a rally in the global equity markets, after the elections here. That would be your upside target. But as of now, any rallies back up to that level offer objective short entries with a stop somewhat above. Or you wait, if you're bullish, you wait for a breakout above that level. But, to go long here, I just can't make a case to do it. EWA, Australia. All right, so this is my chart with trend lines. A lot of little levels. Don't worry about those. Let me just show you what I'm focused on here. Is this multi-year trading range. In fact, we even had it back there too. This has been really the level, other than this period, this bear market period, that again V-shape. Central banks flooding the system with liquidity, buying the markets up, buying the bonds. Same thing here, our V-shaped, drop, and central banks' response to that. But from a technical perspective, big BIG with capital letters, big resistance level, similar to the UK, because you can see for years, numerous reactions, both from above and below. That helps to validate that level. So here we can see it here. But and of course, the recent divergent high. Here's a current box, a smaller trading range that may determine the next trend. Bulls want to see bulls want to see recovery back into the zone. I should have extended that over. I'll show you on the next board. Bears want to see a breakdown below the bottom of that recent trading range. And that's what it looks like right here. So you can see it nice and clear. So there it is. EWA is at resistance. TA 101 or Trading 101 says you do one of two things when a stock rallies into resistance. You either short it if you think it's going to be rejected off that resistance level, or you wait for a breakout, a convincing breakout above it to go long. And again, if you go long, I give you, swing or trend target. Target the top of the range or at least the midpoint. I can give you a midpoint line right there. I see a gap and I see a lot of reactions in the midpoint. So about 22.15. Last but not least, FXI, and again there are some other ETFs out there, but this is how I have FXI pretty much boxed in this range. Here, let me see, there it is, a little more clear. It spent a lot of time. It had a period where it broke above it and tried to take off the new highs, and then fell back, tested the top of the range. Finally, when it gapped down into it, that's it. That's a break of support. Boom, all the way back to the bottom. When it hit the bottom, all the way back to the top, all the way to the bottom. I mean, this is Trading 101. You find these ranges. However, there are times. That's what stops are for. If you bought the drop to that range during the COVID drop, you probably got stopped out. If you didn't and you held it, then you snap right back. Or if you waited to the recovery back into the range, great. If we recovered it, tested. Once the market saw it successfully tested the bottom of that range, boom, right back to the top. So that's it. We're kind of in no man's land right now. We're shy of the top of the range, yet well off the bottom. And again, if you just take a step back and look at the bigger picture, what's going on with China, or at least this ETF, exclude that little whipsaw that you blinked and it was over. This is where we've traded now for going back for the last couple of years. Okay, that's it. I'm going to get this out to you again. I'm sorry about missing the mic or the pause button on that cough earlier. Editing these videos after they're done, it's so difficult, it's not even worth it. So I just hit the produce button, upload it to YouTube, and get it out to you guys. So I'm sorry if that blew out anybody's eardrums. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.